Welcome to the UnTaxables, the podcast where smart entrepreneurs get strategic, stay compliant, and keep more of what they earn. I'm Haylee Kurka, enrolled agent and owner of Noble Tax and Accounting, and I believe that you can spend your money better than the government ever could. Here, we make tax strategy digestible and approachable, building smart, simple systems that save our clients thousands every year. Get smart, get strategic, get untaxable. Well, hello and welcome back to the UnTaxables. So glad you're here and glad to be able to do this podcast talking about 3 year-end tax moves that actually matter. And these are things that you can do now before December 31st that do move the needle. And these are basics. These are not going to be super in-depth. They're not going to be exhaustive of things that can be done. But I wanted to touch on them just because sometimes it's the small changes or tweaks to a plan or a strategy that can make a big difference. So let's dig in. So every December year end, we hear people kind of panic asking, what can we still do? What can we write off? And that's not the only move that can be done before the end of the year to either shield yourself from tax liability this current year or get ready for the coming one. So most year-end advice can tend to be a little bit of busy work. I want this to be super practical, super applicable to your situation and actually moving the needle on your tax bill. So let's dig in. The first of the 3 moves is going to be structure and payroll related. And I want to talk about this just from the perspective that actually how you're structured matters more than what you spend for a write-off. And what I mean by that is just making sure that your entities are in the correct structure or your businesses are structured correctly so that you are actually maximizing your tax savings and minimizing your tax bill. So are you an S corporation? Are you a sole proprietorship? Are you a single member, multi-member LLC? What type of is your business entity? That's kind of going to be the foundational question that's going to need to be answered in order to know what kind of structuring discussions need to be had before year end. One thing is if you are an LLC that netted more than $50,000, which netted means your revenue minus your expenses is your net income. If that number is greater than 50,000 or you're sitting right about that, then I would highly recommend that you get on the schedule of your tax professional and make sure that that conversation can happen hopefully before the end of the year. Having an LLC in place gives some flexibility for potentially making an S corporation election for the current tax year back to the beginning of this tax year, or if your LLC is new to the date that it was effective in 2025. Your LLC provides what we call S corporation insurance, which is a phrase that I actually learned from my mentor, Mark Kohler, and he uses this to describe having an entity in place that can then have an S corporation election made for it retroactively. So that's exactly what I'm talking about here is if you have that LLC in place, you're making decent money, you have revenues minus expenses that equal $50,000 or more, it's a really good idea to meet with your tax professional before year end and chat with them about whether or not an S corporation makes sense for you. S corporations don't make sense for everyone, and it all depends on the goals of your business, revenues, obviously, profits, the way that you do your bookkeeping, whether or not your business is in a growth phase or one of actually reducing operations. There's just so much that goes into this conversation that I can't tell you 100% across the board that at that revenue or profit level, it's going to make sense for you. But it's a good starting point to open that discussion and find out if it would work for you and if you're going to end up saving on self-employment taxes by doing so. If you don't already have an LLC in place, this is a really good time to start thinking about that. So again, more than one factor would come into whether or not it makes sense for you. But if you're making money in your business, you don't have an entity in place, and you're thinking that the business is going to continue in its operations or even grow, then having an entity could be the next step for you and could essentially put that S corporation insurance in place in your business so that as your business continues to grow, your profits continue to grow, you're ready to make that election when the time comes. Now, unfortunately, if you don't have an LLC in place and you're here at the end of the year and you've made $50,000 or $100,000 of profit, there's not anything we can do with an S corporation to save you from those self employment taxes that are going to actually apply to you. There are other types of things we can do. We want to make sure that you're capturing all of your deductions and that kind of thing. Maybe you need to do some more year end write offs to lower that tax bill. But in terms of the actual S corporation strategy, it's not going to work unless you do have that LLC in place already. So that's something that I want you to think about going into the end of the year is maybe this is not something you have in place now, but everything for your business is pointing toward it being necessary next year. Well, let's get it in place as soon as possible in the new year so that you can take full advantage of the next tax year as potentially an S corporation or even a different entity structure. So that's a conversation I want you to really start thinking about having with your tax professional. Just as an example of this, I did have a client in this specific situation came to me at the end of the year, kind of worried about his tax situation and asking, what can we do? Like, what strategies are there for me? And he was actually netting over $500,000 in his sole proprietorship with no LLC or anything. So it was all getting reported on his Schedule C. Fortunately, we found him a huge amount of tax savings, over $40,000 that were going to be applicable each year. Fortunately, those savings only could be applied for future tax years, not the one that we were in currently, just because he did not yet have an entity in place. So that's just a little anecdotal evidence of let's talk about this because he paid $40,000 more in taxes than he needed to with that because he didn't have that entity in place. There was no retroactive S Corp election or anything that we could do for him there. Finally, the other kind of category you might fall into is already having an S corporation. They're pretty popular. A lot of people have S corporations, well talked about online. And so maybe you already have one in place. Then I want to talk to you about year end moves for in regard to reasonable compensation. So first thing is make sure you're taking a reasonable compensation. Like that's just number one basic. This is a common area that's overlooked with S corporation owners for various reasons. Maybe you've just gotten busy and didn't run payroll. Maybe you're having cash flow issues and thought, well, that's an easy one that I could cut. But whatever the reason is, it does tend to be overlooked more frequently than it should be. And so, number one is just make sure that you're actually taking a year end compensation. I do prefer for my clients to be taking that payroll throughout the year, once a month, maybe once a quarter, but really I prefer once a month. I do have some clients that decide to take it annually near the end of the year in one lump sum, and that's okay. But I just prefer for cash flow management and stability throughout the year just to go ahead and do that on a regular basis. You also are going to want to make sure that your reasonable compensation that you're taking via payroll is actually reasonable. And this is another one of those areas that, first off, there's varying advice that you're going to find amongst the tax professional community. And it is what I consider clear as mud from the IRS and from the code, in that they don't define it clearly for what we should pay for reasonable compensation. So we do have to take in a lot of different determining factors to determine what that payroll should be. And some of those are going to be your revenues, your profit, where your business is located, what your job title is, what kind of activities you're doing in the business, et cetera, et cetera. So it's not just a simple, here's a formulaic way we can figure this out. We can start with a formula to kind of start that conversation and figure out where you might be. But we do need to do some deeper research and have some more of those factors in place to determine what it really should be. And here's the thing, we don't want your reasonable salary to be too low or too high. If it's too low, it's an audit risk, right? If you're making $200,000 net and you're taking a $20,000 salary as the owner, that's going to be a no-go with the IRS. And maybe you get away with it. Maybe they don't audit you for it. But if they were to audit you, they would not approve of that in that situation. So then the other obvious kind of side of that is too high. We don't want it too high because then you're overpaying in your taxes and you're paying more FICA tax, which is Social Security and Medicare, than you actually are needing to be paying. So we want to get you in that happy spot in the middle between too high and too low. We want you to be kind of just right and be able to mitigate as much of those payroll taxes as possible. The other thing I just wanted to note on this was that S corporations are audited on this particular question more frequently than any other single line item on an S corporation tax return. Reasonable compensation is a hot button issue for the IRS. They want their S corp owners to be taking a reasonable compensation, and it's really important. If you have an S corp, you have not taken reasonable compensation yet for 2025, you need to do so before the end of the year. And your tax professional should be able to help you run an amount that's reasonable. Keep in mind, too, that once you do run that payroll, you will have the associated payroll taxes to pay with it. And so just plan ahead for that in terms of a cash flow scenario. Okay, number two in my 3 year end moves that actually matter. Number two is going to be timing considerations. And what I mean by this, and what I want to talk about is, and I did actually talk about this a little bit on my last episode, but a lot of times, many tax professionals will recommend year-end write-offs as kind of the only way to mitigate taxes. So that's not the truth. And you know that already. I am going to be talking about that extensively on my show, just that is one of many, many strategies, and it's often not even the best one. We want to keep in mind that the kind of timing considerations when we're making these kind of year-end decisions, and that is the topic that I want to dive into right now. So not everything should be rushed at the end of the year just for a write-off. Here's a couple practical examples. One, if you're going to have a very or higher income year next year than you are this year, then you might not want to take write-offs this year that would help lower your tax liability for next year or keep you in a lower tax bracket than you would otherwise be in next year. So you want to be thinking not just about the current year, but also the next year and what your income level is going to look like for that year as well. If you need to buy a vehicle or equipment this year and you're in the financial position to do that, then it could be a very excellent decision. But again, you want to think about what you're making this year versus what you're making next year and make a strategic decision about which year that you want that write-off in. Maybe it's worth waiting until January 1st to actually make that purchase and put it into service in your business so that you can claim that write-off on 2026 taxes versus this year. Another timing consideration strategy, and this would apply to everyone, not just business owners, would be on itemizing deductions on your personal tax return. And I've actually recommended this strategy recently to one of my clients because it just worked with everything he had going on. But this is going to be especially interesting or available if you do a lot of charitable giving. And so this is going to be where you pre-give your charity in 2025 versus waiting till 2026. So let me run through kind of just an example on this real quick. If you are in 2025, married filing joint couple, you've given $20,000 already to charity this year. Maybe you have about $4,000 of property tax, and you have another $4,000 in mortgage interest. Your itemized deductions of those three things only would be $28,000. That's still below the threshold of it being more beneficial to itemize. That threshold in 2025 is $31,500. So if you decided, hey, let's give a little bit extra this year that we would be giving next year, maybe bump yourself over that standard deduction amount. Now you itemize, you take full advantage of all of your deductions and get a better write-off. And then next year, you're still you'll be giving less than you would otherwise because you pre-gave it this year, but you still take advantage of that very high standard deduction and are able to take that on your 2026 tax return. So that's another idea. It doesn't work for everybody. Again, it has to do with cash flow or cash availability and whether or not you do want to do some pre-giving, but it can also be a good way. Maybe this couple in this scenario wants to pre-give their entire amount that they would otherwise give. So they've given $20,000 for this year. Maybe they're planning on giving $20,000 next year. And instead they do it at the end of 2025 and they have $40,000 to write off this year. And they still get their standard deduction of over $30,000 next year. So this is a mechanism to consolidate giving. I already said that, into one tax year instead of spreading it over 2 years. The same concept can kind of apply to businesses that have deductions. And you can prepay expenses that you're already going to pay next year and just get them paid ahead of time if you're looking for a year-end tax write-off now. So this could be rent, service providers, your accountant. Sometimes we'll accept payment early for services we're going to perform next year. Keep in mind, though, that prepaying expenses, you run into the same kind of strategic planning that you need to do for any year end consideration. Think again about if I prepay my rent, maybe that's $24,000 that I'm going to pay this year instead of paying next year. But next year, I'm expecting to make an additional $100,000 in profit and be in a higher tax bracket. Well, it might be better to save that $24,000 and pay it in the next year so that you can help to lower your tax liability in the following year. That's all something to keep in mind. And finally, prepaying your expenses like this is only going to apply to cash basis taxpayers, not accrual. And don't have enough time in an episode like this to get into the differences. Maybe we will at some point in the future. But generally, most small business owners are cash basis taxpayers. Couple notes on this section before we move on. Write-offs are not going to help if it creates financial stress or you don't have the cash to do them. So it's kind of a moot point if you don't have cash. Secondly, thinking ahead to next year, just reiterating that point, don't shoot yourself in the foot by doing something this year that is going to mitigate taxes this year, but might actually have a bigger tax impact for you next year. All right, number 3, planning for year end or planning for next year before this year ends. So there's going to be a couple things here. The biggest mistake that I see is people waiting until January to kind of do anything. They're like, oh, maybe it's a New Year's resolution or just a habit change. And they're like, oh, I'll just do that next year. Start now. Start now with whatever those things are. Get on your tax professional schedule now. Don't wait until January to do these things, because what happens is January, you can easily just throw things by the wayside that really should start earlier. So the earlier you start a habit, the earlier that you take initiative on something, the more long-term benefits you're going to see from it. Waiting until the last minute to get on your tax pros calendar is not going to be in your best interest. I'll have a little note here or kind of a sidebar, I guess, just to let you know that treat your tax professional kindly. The tax season's coming up. Tax professionals at industry wide, we have less tax professionals in general, fewer tax professionals entering the industry. And yet the demand for professional tax services is increasing due to expansion in the small business community and that kind of thing. So a lot of tax professionals are overworked and are stressed out. They have way more work than they have hours to do. And so just get on their calendars early, be patient, be kind, and treat them the way you want to be treated. So that's my little shout out to treating each other kindly during tax season. And I appreciate it for sure when my clients do so for me. The other thing that really is going to make a big difference for you at year end is just making sure that your bookkeeping is up to date. This might seem like a goes without saying kind of point, but I wanted to bring it up because there's oftentimes that I have a client come in January and we're not on a monthly engagement with them. And so they're in charge of doing their own bookkeeping. They come in wanting a quick turnaround on their taxes, and we can't move forward without accurate books. They're going through stress of trying to put together their records and make sure that they've captured everything that they should capture. And maybe they're missing things because they're in a hurry. And really, it just makes a much bigger impact on your stress levels and on the accuracy of your bookkeeping. If you can just get it done, get caught up, you're going to have obviously some more transactions by the time the year ends. But just get as much as you can done. Take your time. Be thorough, look for all of those deductions, and make sure that your mileage log is in place. If you have an accountable plan in your business, then make sure that all of the expense reimbursements have been done appropriately. And just all of those little administrative things like that need to be done so that in tax time, when you do go to your tax professional, it is easy. They have what they need to do their job well, and you don't have to rush through or be stressed trying to get that all done. If you want to get on my calendar for consultations, either year-end consultations or for next year, any type of small business tax planning or bookkeeping or anything like that, you can do so via my website, noble-tax.com, and click on services. You'll be able to schedule consultation there. Then next episode, we're going to talk about the most expensive mistakes that I see every January during tax season. So that'll be interesting. Tune back in for that, and we'll talk again later. Thanks for tuning in to the UnTaxables. Be sure to like and follow our show and tune in again next week for more tax tips that keep your hard-earned dollars in your own pockets instead of sending them off to Uncle Sam. Until next time, get smart, get strategic, get untaxable.